All right, I think it's that time. So let's start. I'm Tom Vartanian. This is JP AUFFRET. And we're glad everybody's here for this program. We've got over 650 registered. About 400 and something will be online. So this room's going to fill up, I think, as it gets a little later. You early birds will get the best of the best early in the morning. But we'll probably have about 200 people in this room, so it'll probably fill up. We're delighted to have you here. We're delighted to be able to present what I think is just a who's who all-star cast faculty to talk about what's going on in the marketplace and what we can expect from financial services. Since I retired from the practice of law in 2018, I've been thinking about this a lot in terms of where we are. And we had a speakers dinner last night, which I thought was interesting. At the speakers dinner, the one thing that I think permeated just about everybody's comments is that the current system is broken. I believe it's broken for a number of reasons. It's been broken for a long time. But fundamentally, we have this asymmetrical regulatory system now. We have the banks, which are no longer the major player in financial services. You can argue they're now actually become a minor player from the point of view of consumer deposits. And they are over-regulated. And the rest of the 65 to 75% of the financial services market is largely unregulated from a prudential point of view. I know they think they're regulated. But unless you've been prudentially regulated and told where to go at 1 hour of the day, you're really not very regulated. And so, you know, that system, in my view, is an invitation to chaos, and chaos is generally an invitation to financial panics and financial crisis, which is what I wrote my book about in terms of financial panics over the last 200 years. It's a number of ingredients that go into each panic and each crisis, and unfortunately, we've got a lot of them percolating at this moment, including the general chaos in the financial markets, which of course doesn't help at all. And so this is a perfect time to talk about where the markets are going, where financial services are going, and we've got a terrific cast. JP, why don't you say a few words and then we'll introduce Elizabeth.
I wanted to thank all of you for joining today on behalf of George Mason University and on behalf of the Financial Technology and Cybersecurity Center. Many thanks to all the fantastic speakers and to Tom Vartanian and Bob Ledig for helping to organize the event. In regard to the program today, have the program up at the registration desk, but we have 5 main sections. The first section on why don't we see financial crises coming and how do we make supervision work better. A middle section on cryptocurrency, regulation of non-bank financial assets, building a new regulatory model, and then wrapping up with the risk and possibility of AI, use of AI and regulation and stress testing. So I think it's going to be a really wonderful program, and thanks to the speakers. We have 2 donut breaks, opportunity to meet with some of the speakers. This morning at 10:10 with William Isaac. Many thanks to William for joining, Randy Quarles and Bob Ledig, and then one in the afternoon. And we have a buffet lunch midday. So thank you again, and with that, I'll turn it over to Tom to introduce our first speaker. One other note, most of the speakers are going to be here in person. There's several that are going to be remote, so it'll be a good mix. So Tom.
JP, thanks, and let me thank you, JP, and George Mason University for the tremendous facilities and the support and help in putting this together. So we're going to start with a little bit of an eclectic feel and international feel to what this is all about. And we've got someone who's actually been a regulator in the United States and in Europe. Elizabeth McCaul is joining us from somewhere on the planet. I'm not entirely sure, but she should be with us. Elizabeth and I started working together probably about 120 years ago when she was 10 years old. And we've known each other through a lot of incarnations. Elizabeth just finished a 5-year tour as a member of the supervisory board of the European Community Bank. Prior to that, she was running the European global practice at Promontory Financial. She has been the regulator in New York, the superintendent of banks, and prior to that was with Goldman Sachs for about a decade. So Elizabeth's got a tremendous amount of experience. We thought it'd be interesting to start in terms of what she's seeing globally and particularly in Europe before we get into what's going on in the United States. So, Elizabeth, good morning. Can you hear us?
Good morning. Yes, I hear you. You made me sound like I'm 100 years old, though. Can you hear me okay?
Yes, we can, Elizabeth. Can you hear us?
Yes, very well.
Good.
Thank you.
All right. So what I want to start with is, given your experience, I know you've been working on a number of things and a number of projects in Europe of recent date. I want to start with the discussion about capital. One of the things I've argued is that we focus too much on capital as a sort of elixir and a cure-all for all that ails financial institutions. And I don't think that's true at all, but you've been working on a capital project in Europe. You've been both in this country and in Europe seeing how banks operate and control risk management. Give us your sense of what it takes to actually regulate a financial company properly from the point of view of capital liquidity.
Sure. I mean, capital is sort of, the Bible for supervisors, for regulators. It's the first port of call in the markets. When we think about capital, the phrase that comes to mind is capital is king. And the bottom line is you need to have enough. And it's an art, not a science. It's, the amount of capital that needs to be accumulated has to be an amount that allows an institution to build a fortress to withstand vagaries of the marketplace and withstand market dislocations. It's about creating the right level of confidence in that institution's risk-taking, risk management capabilities. In Europe, I've been working with a supervisor now that is just celebrating its 10th anniversary. The European Union created the single supervisory mechanism on the heels of the great financial crisis, and in an extraordinary way brought together all of the national competent authorities across the nations in Europe to put in place a single supervisor. The birth of the ECB's supervision program happened at a moment when it was a crisis of capital. It was a crisis of confidence in the banking system, and by its very nature, the building of the SSM took place against a backdrop of rebuilding that confidence in the banking sector, recapitalizing the banking sector, breaking the doom link between the institutions and the sovereigns. And so as a supervisor, the ECB was very correctly, very focused on making sure that the right level of capital was in place in its institutions. What we've realized, and I think this is true on both sides of the Atlantic, is, and you said it, Tom, capital isn't the whole story. For supervision, really effective supervision has to have the right level of capital in place. So we'll take that as a given. And then it's about qualitative measures. It's about using the other tools in the toolbox to make sure that if deficiencies are identified in an institution, that the supervisors put in place the appropriate remediation programs so that those deficiencies can be appropriately addressed, so that the risk-taking capabilities of the institution are being properly identified and managed. And so the very strongest tools, I think, that need to be in place sometimes are the ones that are focused on effectively building the control structures in the institution, the governance structures in the institution, strengthening the institution's ability, especially in the markets we're in now, that are so complex and that have grown so much beyond the regulatory perimeter of banks, that they can identify where there is risk building up and have appropriate procedures in place to manage it. So to me, spending a lot of time on the other tools beyond just the calculation of the capital amount is paramount.
So Elizabeth, you and I have talked about the theory of financial regulation, something that I've had a lot of time to think about myself. And I think we both agree that sometimes financial regulation gets upside down. In the way I articulate it is, over the years, we've become so rule-oriented and so far moved away from principles that we end up regulating the trees and miss the forest. And I know you've done a project in Europe on top-down, bottom-up regulation. Give us your insights and views on the overall theory of regulation.
Thank you for that question. It's a big question. Let me start with the effectiveness of supervision and a project that we undertook at the European Central Bank, which was a very prescient brainchild of our chair at the time, Andrea Enria. In 2022, looking forward to the 10th anniversary of the ECB, he thought it would be a particularly opportune time to invite in luminaries and have a wise person's review of the supervisory program completed. And that review, we opened all of the books and gave luminaries 5 former persons of gravitas, former supervisors and persons of gravitas, an inside look into how we structured the supervisory program at the ECB. And, very interestingly, what they found is, and they delivered their report very serendipitously into the week of the March market dislocation in 2023, when all the world was asking the question, where are the supervisors and is the supervision that's in place effective? They issued a report that said that the ECB's young program was indeed quite effective. But for the next 10 years and the next 20 years, that what we really need to be doing is focusing on using the authorities that we have in place, moving from a very rigid, rules-based program that was necessarily built at the very start, and I'll spend a minute on that, and move more toward using supervisory judgment and using the other tools in the toolbox. You said it, Tom. The programs that have tended to be put in place are very rules-based and not principles-based. But the fact of the matter is that when you're operating in the markets, you need to be able to act with precision and with incredible speed. And you have to have very qualified, experienced individuals in the positions assessing the risk and equip them with the authority to be able to react in order to prevent a financial institution from a meltdown, if that's possible. And so, at the ECB, it was developed, again, as at an extraordinary moment when the sovereigns were at risk, and the linkage between financial institutions and the sovereign debt markets of very large countries was exquisitely drawn, so that not only the banks were looking at failure, we were also looking at failure of nation states. And so by design, at the very beginning of the European Central Bank's supervisory program, what was developed was something that gave up sovereignty to different jurisdictions, to different nation states, and designed a program that would be executed in a centralized way, but in coordination with the national competent authorities. You might imagine correctly that it wasn't a moment when everyone trusted each other. Would an institution that was domiciled in one jurisdiction have preferential treatment because of the way it would be supervised? Would all of the institutions be subject to an equivalency program and a consistent and quality supervisory program? What that meant was that a very elaborate set of rules was put in place so that the centralized program that would be executed in Frankfurt in coordination with the national competent authorities would be completely consistent. The bottom line is, and the realities of the market are, that you need to be able to exercise judgment. And, you mentioned, Tom, bottom up and top down. As part of that wise persons work that we did, and I was the project sponsor for that work at the ECB, we had a chance to meet with many very qualified supervisors around the world. And one very wise colleague said, I think quite accurately, that when you have a supervisory program that's based inside of a central bank, you need to beware of a methodology that is just part of the culture, which is a top-down approach. Monetary policy is by design something that is set on a centralized basis with a top-down approach. Decisions are made at the very top of the organization, and then they are executed on. Supervision is exactly the opposite if it's done well. Supervision requires that inspectors and the program are geared toward assessing and understanding risk on the ground. Where the rubber meets the road is where an institution's deficiencies and potential liabilities can be best observed. So you must design that program such that the bottom-up risk view can be filtered back up to the top of the organization. You need a top-down view, you need a middle view, but you absolutely need the view from the ground. And so, this is a topic of a lot of discussion in the recent days. That means that you have to trust the judgment of your supervisors and enable them to pass information up the chain so that the right assessments can take place. And they need to take place quickly, very quickly, because the markets change on a hairpin turn, as we all know.
Elizabeth, let me ask you one more question before I hand it off to JP to ask a few questions. I spoke to my friend Peter Wallison this week, and Peter is just released a paper entitled "The Proposal for Privatized System of Supervising and Insuring Banks." And in essence, what he suggests is that we go to a sort of a accountant firm regulation of banks and a syndication form of FDIC insurance. Those are both things we have done in the past in this country. Before we had deposit insurance, syndicates were sort of the clearinghouses at that point, were sort of central focus. But the premise that he lays out is what I want to ask you, and that is, his premise is that financial regulation has proven that it has failed, and largely because of the number of financial panics we've had in this country. I don't know if Gary Gorton is here yet, but I think Gary said in his book, the United States has had more financial crisis over the last 2 centuries than any country but Argentina. That's not a great record. Right. So, and we have the most comprehensive system of regulation. So how is it that we have so many financial panics in this country? The question is, I guess, from that perspective, Elizabeth, now that you've seen it from both sides of the Atlantic, why do we miss financial panics? And why is the system of oversight and supervision always playing catch up?
I think there's, it's a little bit like assessing the medical condition of a patient. It's usually not one symptom and one cause. You've got to really understand holistically the whole patient. And there are a number of things that come to mind in response to your question. The first is, the age-old adage of mind the gap. And mind the gap, there are plenty of gaps. We have an incredibly complicated system of supervision in this country. The alphabet soup, letters that go together that describe the numerous agencies that play various roles in the supervisory fabric. Where are the gaps? In general, what I think we've learned is that we see that financial crises often emerge where there's not a good handoff between supervisors, or where there is a lack of structuring the regulatory perimeter in such a way that that risk is adequately captured. So that's the first thing that comes to mind. But secondly, and maybe this is, arguing against myself a bit, I might argue that we do see crises coming. And they're often blindingly obvious and right in front of us. And somehow, through the elaborate bureaucracies that have been put together, we are unable to somehow properly control that risk with the appropriate regulatory perimeters, the appropriate cooperation between agencies, the appropriate international consistency to the way that the financial markets have continued to develop. What comes to mind for me right now in these days, and for me, it feels a bit personal, is, the growth of the private credit markets and the growth of the private equity markets. There are very important discussions taking place at the Financial Stability Board. I think internationally, supervisors all recognize that we've seen this before. We've seen where there is, an emerging risk, and that it's not adequately transparent, adequately supervised, and there's not enough information to be able to assess where there is a risk that is becoming outsized. And so in the private credit markets, I think the most important thing that has to be put in place is more transparency. That market has doubled in size since 2008. It's grown from 15 trillion to 32 trillion. It's an important part of the economy. There is important lending that is taking place to small and medium-sized businesses in particular. But when you look at the structure of that component of the market, some 47% of the market is controlled by 8 large firms. And those 8 large firms have historical knowledge, they have deep experience, they've seen credit cycles. Many of the players in those large firms have had deep experience on the banking side. 53% of the market is in the hands of much smaller 1,000 firms a year ago when I last looked at those numbers. And the question for me is, and I said this was a bit personal, I was in office when long-term capital management happened, and we learned for the first time where there was a nexus between market risk and credit risk, and that we had to analyze the holistic exposure, and it needed to be understood where there was a correlation risk between the balance sheets of the banks and the risk-taking that was happening via a lending arrangement to a third party. This is happening in droves right now, and we don't have appropriate reporting to understand where that risk is really developing with an interconnectedness to the banking system.
Thank you, Elizabeth. Related to that topic, and also differences and similarities between U.S. and European Union regulation and approaches, how might the recognition of a risk like that happen both in the U.S. regulatory system and European Union, and how might the recognition and then the follow-on be different?
I'm not sure I fully got your question. You broke out just a bit there, JP.
Oh, for the private credit risk, how might the recognition of such a risk occur or happen in the European regulatory system and the U.S. regulatory system?
Sure. Archegos comes to mind. This happened not in the not too distant past, where a number of institutions had credit exposure to Archegos, and it was not known about the other exposures that were there. Institutions didn't have full line of sight into what the financial arrangements of Archegos was. So I think we have a live case in point where we see a number of players in the market entering into a variety of financial arrangements with a firm, and then having had no visibility into other exposures that institution had, what the covenants were that were in place, and it managed to blow an enormous hole in the balance sheet of a large institution. So the way it will play out is where you have derivative arrangements, lines of credit, direct loans, and then you have risk taking place by that entity that's on the other side of those trades with an institution, and then you have an outsized risk that develops without having an opaque and outsized risk developing that then is uncontrolled and causes losses. I think it's quite possible that we could see that development. What comes to mind also is there's that movie right after the great financial crisis, not The Big Short, not the Hollywood movie, but Hank Paulson's documentary. And it's worth revisiting to have a look at that movie again. And at the very end, there's an epilogue where he issues a warning to the marketplace. And he says, in effect, beware the growth of the shadow banking market. And that was in 2013. And that growth has exponentially expanded for a wide variety of reasons. And there hasn't been concomitant, at a minimum, reporting put in place so that one can appropriately understand what those exposures look like.
Elizabeth, let me turn just a little bit before we open it up for questions from the audience to technology. And the question I've been focused on and thinking a lot about, particularly over the last few years, has been cybersecurity. And reading the experts, interviewing and talking to the experts, I've concluded that we are underestimating the threats of cybersecurity throughout everything. And financial services is obviously extraordinarily important. Are we underestimating them? And how is Europe looking at cybersecurity and the risks that are emanating from cybersecurity? You know, one of the things I did when I was working on my second book was I read all of the minutes and all of the annual reports of the FSOC. And, you know, it really is quite interesting. And every report in the last 6 years had something on cybersecurity. It went from 2 pages to 6 pages, right? But every conclusion struck me as FSOC saying, there's a fire burning, somebody ought to put it out, right? And the question is, who's the somebody, right? And I know the individual agencies are working on it individually, but that gets to the question of the seamlessness of this problem. What are you seeing? What have you seen in Europe with respect to cybersecurity, and are we underestimating the threat?
You know, the blunt answer to your question is I think we are underestimating the risk. If you talk with CEOs, with chairs of risk committees of the boards, with chairs of the boards, with risk officers, you know, you will hear a resounding refrain that the number one risk that they're facing is that of cyber risk. That led us at the ECB to conclude that we needed to put IT risk, operational resiliency near the top of the list. And we took the very unusual step of designing our stress test. I think it was the first in the world to assess the risk from cybersecurity. What we did was, you know, we made very clear that this was not going to be a capital exercise. The outcome of the stress test exercise, unlike others before, was not going to be an assessment of the adequacy of capital, because really what we needed to test was the institution's ability to recover. How would they react if a core banking system was successfully breached, successfully attacked and taken down? And so we designed a scenario based on a variety of business models. And so, you know, we have a very wide portfolio of institutions that we supervise in Europe. And, you know, you have the internationally market-based institutions, you have single risk institutions in particular domestic markets. What we did was design a scenario that would take out the core banking system, depending on that business model. And then we had the institutions walk through the exercise of how they would approach recovery and how they would approach getting back online, getting back up and running. I will say with a smile on my face that it might be the first time that I've seen a stress test welcomed by the banks that are supervised. It was an incredible learning exercise for them. We found numerous weaknesses in the institutions, but that was exactly the objective, was for the institutions then to be able to design their fortress and their recovery system so that if a successful attack took place, they would have the tools in place to be able to get back up and running and serve their clients and customers and operate in the markets. You know, in Europe in particular, and you know, I have to say, I think this is true also for the US at this moment, we identified the linkage between rising geopolitical risk and named it, that the rising geopolitical risk in which our institutions are operating now is directly linked to the possibility of increased cyber incidents. Now, before I mentioned a phrase that, I think is very important, and that is the mind the gap phrase. If there is an area of risk globally that is fraught with gaps in the oversight processes that are in place, it is certainly cyber. You have a patchwork of authorities that are overseeing cyber risk, from defense departments in particular national jurisdictions to banking supervisors, and everything in between. And so, there is a real need to increase the communication, the sharing the details about the types of risks that are coming up and how to address them, how to build a wall against them, and that neurological framework is not in place globally. It's not even in place in single countries. So if you can imagine in Europe, where you have wide variety of sovereigns, and a wide variety of methodologies for recording and dealing with cyber risk, you will correctly imagine that there's a great deal of need to bring about much more cooperation.
JP, I think we'll open it up to questions, but one thing on this subject I want to add to Elizabeth. I was really taken aback when I saw our Federal Reserve Bank of New York report on cybersecurity. I think it was 2020, Bob. Do you remember what the date was? I think it was 2020. Basically said if one major bank in New York was adversely affected by a major breach, it would affect 35% of the financial services system processing. That's pretty stunning to me, and led to my conclusion that we may be underestimating the effect, because if there is, quote unquote, a cyber war, it's just not going to be one institution that has a breach. But with that said, let's open it up to some questions from the audience. And I think we have mics set around, so people can rush to the mics.
I have rushed. Thanks very much for your comments. I'm going to name a phenomenon, and I'd like to know whether you are aware of this or how it colors your concerns. And this goes to the growth of private equity and private credit without transparency. What I see is there is an all-out push now to bring these private assets into individual investor portfolios, so is expanding them even further. And that doesn't just mean accredited investors. There is an attack planned on the 401k industry, which currently defaults into target date funds with publicly traded stocks and bonds, to include a category called private alternatives, with no one understanding what illiquid securities mean when things go haywire, and how it's reminds me of 2008 in an effort to spread out home ownership, well-intentioned but disastrous.
I completely agree with you. I'm very reminded of the subprime crisis when I look at the growth of the private credit market, private equity market, I would focus in on that disintermediation which took place with the structured credit products that were then securitized and sold. So I'm aware of the push to allow 401ks and allow individuals to invest in this segment of the market. And that, opening up a market for additional investment, that's generally speaking a very good thing. But there's a lot that needs to go along with that. And I think you said it correctly when you focused in on the illiquidity of the securities. These are, for the most part, level 3 assets. A very small percentage of the loans that are made to private alternatives, to private credit, are listed securities. Really small percentage where you can get detailed financial information about balance sheets and about risk that is in those in those lending arrangements. the illiquidity should be, something that is, and Tom, you mentioned, the house on fire. We should all be extremely concerned about what's happening with the valuation in these portfolios with these level 3 assets. What are the fair market value that's in those? And, what kind of exposure is taking place there? It's an extremely important open question, and it has a tremendous amount of risk associated with it. And as I said before, I think we often see the financial crises coming because we recognize the elements, we recognize the symptoms, and then there are not the tools in place to appropriately rein it in and bring it under control. And then, of course, we end up with, too many rules is also the other side of that coin.
Okay, we're going to continue this. Elizabeth's going to stay with us, but let's bring up our panel. Greg, Gary, Elizabeth's going to stay with us. We'll have Alex Pollock zooming in. And let's have the panel come on up. We'll continue. And by the way, if anybody's interested in Peter Wollason's paper, you can email him at peterjwallison@gmail.com.